One of the easiest way to stop blowing your accounts and losing money is to master the moving averages. You need to learn how the moving averages work, how to use it correctly, and the do and don'ts when using moving averages. It's a very important tool in the forex industry. It's very very underrated. Most traders don't actually know what it is. Some do. They don't use it properly, and then they have lots of problems. But this is a very very important tool that you don't want. You need to learn how to use. And the moment you learn, unlock that secret, you can be able to use it profitably, and then it will help your trading gets better. Okay, so moving averages are technical tools that calculate the price of an asset, or can calculate the average price of an asset over a period of time. So let's take 10 days, 20 days. The average price of an asset over time is what we know as moving averages. So moving averages is actually a price action indicator. It's a price action indicator, meaning it's always updating on the average of price, giving you informations that will help you better take trades that will end up make you profitable. So it is essential that you as a trader know how to use doing averages. One of the reasons why I love doing averages is that easily tells you the trend of the market. It easily tells you the trend of the market, and because one of the rules of trading is that you must trade with the trend. The trend is your friend. So moving averages is one of the ways to easily know the trend of the market. When price is above, when candles are forming above the 50 period moving average, we regard that kind of trend as an uptrend. So when prices are above, for instance, if you go back in time, you can see that this is an uptrend. Price price at this whole point, price at this whole points here, price at this whole points here is above the moving averages, and you can effectively know that this is an effective uptrend. Now, when price is below it, when candles are forming below the moving averages, you can then know that that is a downtrend. For instance, you can see what's happening here. Let me get my pen. You can see what's happening here at this point. This is a downtrend. Price was below the moving averages. So you can easily know the trend of the market by using the moving averages. It will just tell you that that is a down or that is an uptrend. And sometimes you can also know when a market is not moving in certain direction, when the moving averages are too close together, too close together, mean that market is really not making any serious direction. For instance, if you check at this point here, or let me get my pen, this point here, you can see that how close the moving averages are. They're so close to each other, and that will tell you that this market is really not making any serious direction. And then it also tell you that there is no momentum in this market. When the market has a very high momentum, the 20 period moving average and the 50 period moving average will be somehow far apart. For instance, like what you see here, look how space they are. This to tell you of the strong trend, the strong mounting trend in the market. You understand? But when they are close like this, to tell you that the momentum market is actually relatively weak, and you should trade such market with caution. It means that buyers and sellers have equal energy and strength. So there is really nobody pulling the market in any sales direction. So your goal as a trader is to spot heavy momentum trades, to spot trades with high velocity, high power, and once you get in, the market will begin to move automatically in your direction. So you're looking for moving average whenever they are spaced apart, and whether they are uptrend or downtrend, you take your trades easily by just looking at the moving average. If price is below it, if the candles are forming below it, you are okay, that is a downtrend. If the candles are forming above it, you know this is an active uptrend. Now, I want to teach you how to. One of the ways people get this wrong is that they don't actually know how to take in trades. Sometimes when uh, the you just see price above the moving average, like the 50 and 20 period moving average, it's just going to take trades anyhow. No, that's not how to do it. You really have to take your entries at very good position. Don't just come and just take it anywhere because you see price is above the moving average and you take it anywhere. That's not it. You don't get burnt so many times if you're doing that. You enter at a specific position. I'm going to teach you from this video how to best time your entries and make profit using the moving average strategy. So before I talk about how to um, trade using moving averages, I want to hit some points that are very important. A lot of people like trading with multiple moving averages, and that's why they get bonds and don't make profits from using this strategy or using moving averages. You don't need too many moving averages to trade the forex market. Keep your chart as simple as possible with little complications will make you more profitable than when you load your chart with lots and lots of indicators, because those things can be conflicting in data and then they will be messing up your trades. So the best thing is to focus on just two moving averages and you see yourself making loads of profit. Moving averages doesn't work on lower time frames. It will not work on lower time frames. There's so much noise on the lower time frames. There's so much candles going on, so much trend formation happening on the lower time frames. So it will not gonna work. The market is always ranging at the lower time frames, and that would really if make your results mostly on the negative side. You need to go to higher time frames to be able to get accurate accurate signal using the moving averages. Don't trade influence on the lower time frames. Your result will always be pair. Another point I want you to also remember is that not every pair in the currency market actually follow the moving averages. Yeah, you can see in your years that whenever there is a crossover in the moving average, the market suddenly begin to falls down. You understand? That is the first sign to when you think you're taking your trade, you wait for a crossover and then you look for a spot to sell or buy. So in your years, whenever there's a crossover, the market often respects the moving averages by going up or coming down. But in some pair, it does not respect moving averages. So it's not as if it will happen every time. But let it be that 70% of the time, whenever the moving averages happen, there is always markets moving alongside the moving averages. So once you have a first one, this is a crossover. This is your crossover here. Okay, you can see it here. Crossover. Whenever there is a crossover, the candle should start forming above moving averages. You understand? So when that happens, you know this is an active play on formation happening in the market. But some pairs don't obey this rule. Sometimes when there's a crossover, the candles will not. Let's say there's a crossover going to this downside. The candles will start going to the upside. So some pairs does not respect these moving averages. So you need to understand that you have to check or past data to know pairs that respect these moving averages before you consider taking a trade with moving averages. Now, how do you trade using moving averages? Now, the first thing to always identify is a trend. You understand the trend. I told you that when there's a crossover and the candles start forming below moving averages, you have a valid trend. Now, for instance, at this point here, we could see that there was a crossover at this point, and the market started going up and going up and going up, and the market started going up, forming candles above moving averages. Okay, so you found your trend. The trend is an uptrend. Next thing now is to go is remember, stay with your higher time frames. Very important, guy. Stay with your higher time frames. Okay, you can see here the moment you had the crossover at this point here. So at this point here, the candle started forming up, up, up. And it started going on, up, up. So that's very important. If you go back and past, when there's a crossover, the price will start moving in the direction of crossover. So for you to have an uptrend, the red candle, the 50 EMA or the 50 moving average must be below the blue one. You can see that the 50 is below, the blue one is above it. For you to have a downtrend, the blue must be under, the red must be above it. So these are things that you need to take note of. For you to have an uptrend, the blue will be above, the red would be under. You understand? Okay. Here we have a crossover at this point here. There is a crossover here, and you can see that crossover here. Let me get my. There's a crossover here. Sorry. There's a crossover here. You can see that price started changing direction immediately after the crossover happened. Okay, price moved from here because what happened? Price started moving up and up and up and up and up. So that entered at this position here would have made all these profits. So moving average is actually very, very effective in Forex trading. Now, how do you take your trades using moving averages? First thing is to go to the higher time frames, identify the trend, wait for your crossover. Now, wait for price to touch your moving averages, wait for price to either touch the 20 or the 15 moving averages. For instance, price at this point, when price got to this point, you understand? Once price touched the moving averages, it went up. Understand? So this alone is more than 50 pips. More than 50, more than 20 to 50 pips. That would have given a lot. That's a lot of pips. That's a lot of pips. I'm here to share it's a lot of pips. So that alone would have been a massive profit on your part, just simply using moving averages. Even if you have waited after this crossing here, you can see it here, and you took your trades, let's say at this point, you would have still bagged lots and lots of pips from this market, and you have been so rich at that point. You can go back in time. You can see the moment there is a crossing here. The moment there's a crossing here, you wait for price to touch the moving averages. The moment price touches the moving averages in the future, you take your trades. They have made all these pips. There's all these people that have been yours. Price touch there, take your trade. So you can take a trade here, take a trade here. Whenever price touches the moving averages, either the blue or the red, you take your trades. Okay. Now how about the downtrend? Now how about for downtrend? Okay. This is what you have to look for. It's the same thing that applies to the downtrend. Understand? Once there is a crossover, you take your trades. Sorry, let me plug my phone. So if you have a sell trade, if you have a sell, say you have a downtrend, and then you have your crossover at this point, you wait for the market to come to your moving averages. You take your trade, your sell trades around this point, you will have made all these profits. You have made all these profits. The first is to wait for the crossover and then wait for price to get to your moving average and then reject. You need to wait for price to reject at your moving average. There be a reversal, a clean rejection around the moving averages for you to be able to know that that is a clean, that price is about to go your direction. Okay, you need to wait for rejection, move around moving averages, and sometimes moving averages, it must not be exactly at the tip of moving average that price must need to hit. It's actually it's a zone, so it can be close to your moving average or small a little bit above it. But the point is that when price come around the moving average and then gives you a strong reaction, a strong rejection of price, either up or down, that is your entry signal. You understand? Like for instance, look at this point here. Uh, there was a crossover here. Price rejected going up, and then gave a strong pullback, and then price suddenly started going down. Okay, even here you can see that price went a little bit up, gave a strong rejection, and then started. So these are also price got to gets to the average, and then doesn't give any rejection. You have to hold on and wait for a good strong rejection before entering. And see them all the candles here, how they rejected price and then gave us a clear sell signal before we enter. So you have to wait for price to make a crossover. You have to wait for price to reject, to touch, either pass or touch, and then rejects price rejects that moving average, and before you can take your entry. For instance, if you look at here we had the crossover, and then we had weeks rejection, showing that price is respecting the moving average by rejecting going up. And once that's happened, if we had take our trades at this point, would have made or would have actually achieved all these pips. Even here, you see the rejection of price. You see how price is rejecting the moving average. So that's actually how you can trade the moving averages and make lots of pips, which is very, very important in trading world. So please, in case you have not subscribed to this channel, I want you to subscribe, and because we share a lot of helpful tips that will help you become more and more profitable. So share these videos, subscribe, like, turn on the notification bell, because that we do come in more educational videos that will help you stay and be profitable. So see you on our next video, and stay blessed.